Good evening. I hope that everyone is having an excellent December. My name is Marissa Christie. I'm with the Kentucky Center for Agriculture and Rural Development, and we will be going over whole farm revenue protection, which is a form of crop insurance that can be useful to small and mid-sized farmers and works well for diversified farms. So I am going to share my presentation with you right there. So you can see K-CARD, the Kentucky Center for Agriculture and Rural Development. I'm glad to have you watching this webinar. So the first thing, if you're considering crop insurance, is why. Why is this something that you're thinking about? Most people tend to think of crop insurance as something that corn and soybean and other row crop farmers get, but it is available to smaller scale farms. And if you're considering farm insurance, one of the things to ask yourself is how much of your income is from farm sales. So how much risk do you have if you don't get the income that you had planned from your farm? If you don't have an adequate amount of farm revenue, if something goes wrong, if the pumpkin field floods, or if your buyer of tomatoes backs out, is this going to create a financial hardship for you, your family, your farm, those who rely on this income? And so what you can think about is what percentage of your farm sales, as much as can be guaranteed to safeguard your farming business. So if you're like, well, I was planning on making, $80,000, but I need at least 40 to be able to make it this year. And then if you have a poor year of farming, will you be able to farm next year? Is that something that, if you don't have adequate farm income, are you in actual revenue? Are you going to have to give up farming? Are you going to have to sell a major piece of equipment or take out a loan? So farm insurance can help you think through, help you think through it. But farm insurance is one option to help manage your farming risk, especially managing your expectation of farm income. So crop insurance was actually created in the 1930s, to help cover farmers in case of a disaster. How this works for whole farm revenue protection is the federal government works with approved insurance providers to provide coverage. So unlike NAP or non-insured assistance program, that you actually go to a private insurance agent. You don't go to FSA. The rates for federal crop insurance are determined by the Federal Crop Insurance Corporation, FCIC, not individual rates. It's not like going to different car insurance providers. This is a federally set rate. Premiums are subsidized by the federal government based on costs, and if you're a member of any special groups, if any underserved or socially disadvantaged groups. So today, the federal government can subsidize between 38 to 67% of your premium. So getting insurance, the entire cost of the insurance would not be to you. The government would actually take some of that, and it makes it a little more appealing to be able to do that. So there are a few concepts when you're talking about crop insurance. Yield is how much you harvest. Actual production history. Revenue is how much you earn through sales. So when it says whole farm revenue protection, that is, what you expected that's your sales, not your yield. Different production practices are considered in this. If you're organic, if the crop is irrigated, if it's not irrigated, and then the coverage levels. So you can get between 50 to 85% coverage depending on the program. So we'll just keep it simple. If you usually wanted to insure, your average farm revenue, which is $100,000, I'm hoping that people watch this webinar and don't get scared off by that. But if you wanted to insure $100,000 in revenue, then at 85% coverage, you would be insuring 85%. At 50%, you're insuring $50,000. So those coverage levels do vary by program, but for whole farm revenue, it's directly linked to the average that you're approved for. More things, premiums, just like you would think, is the amount charged for the insurance coverage. Subsidies is the amount that the federal government pays of your premium. Claims, just like with car insurance, you file a claim when you have a loss. And indemnity is the payout after your loss is approved. So it would be the money that you recover because you have farm insurance. So with small and diversified farmers, one of the best fits that we found, especially as people are expanding their production, is whole farm revenue protection. It is part of the family of multi-peril crop insurance programs. It is especially good for farms that have specialty organic farm products, because those are commanding a higher price. If you are marketing locally to your customers, so you're getting a higher price. Or if it's farm identity preserved, which means you're branding it as a family farm, it's not being sold wholesale, and you're getting a higher price because of your brand, basically your personal brand or your farm brand. So it requires a significant amount of record keeping. That said, if you are GAP audited or have organic certification, this is not that big of a leap. The record keeping comes in more on the sales side, and we'll get into that a little bit. It does not require separate policies for each commodity or thing produced, since the farm is a whole entity. So you could have cattle, you could have hay, you could have tomatoes and pumpkins and peppers, and that's what's on my mind right now, so that's what we're going to go with. But you could have all of those things. Your whole farm is part of this policy. And we'll get into some of the things that it doesn't necessarily cover. It doesn't cover value-added products, and it doesn't cover forest harvested products. But it covers much of the rest of diversified farms. One common, excuse me, I have a cold. One common used for small, another program is NAP. It's the FSA Non-Insured Crop Disaster Assistance Program. That one you don't go to an agent, and you all may be familiar with it. It's through FSA. It covers individual crops that aren't available for traditional crop insurance in your area, usually in your county. It does not, it's like, hey, pumpkins are worth $1.25 a pound or whatever. That's actually too high, 24 cents a pound. And that's what you get. It's not, you don't get your price premium. It's based on your yield, and it does require a separate policy for each product. But we've had a lot of farmers use that basically as a guard against catastrophe. Multi-peril crop insurance programs in general can insure against revenue loss or losses related to yield. You know, coverage varies by, they actually have a rainfall insurance, or so if it doesn't rain enough and that affects, for example, your forage, you know, if you're raising hay, the rainfall insurance can assist with that. You know, if there's not enough rainfall in your area, then it can help cover some of your loss with hay. So that's another example of multi-peril crop insurance. We don't have a lot of people who use that generally, but it is available, and do want to make people aware that there are other programs that are not just based on yield, and multi-peril, the group in general, is good for that. Well, the first thing you need to do is check and see if you have the necessary records. So, and then you want to contact, if you're going with NAP, you can contact the FSA. But if you're going to do whole farm revenue, you can locate a crop insurance agent. And actually, there is a handy dandy agent locator page on USDA Risk Management, since they do have private insurers that carry this. You can't get it directly from risk management agency. You can't get it directly like Whole Farm Revenue. You have to go through a private agent. So there is an agent locator, and that's good to see who covers what in your area, and you can put in your location. And it's good to call a few agents. Not all agents are as familiar with Whole Farm Revenue Protection. So asking another farmer or someone else who has worked with Whole Farm Revenue Protection, you know, if there's an agent in your area that has worked with other farmers, because sometimes, because it's so different than the other crop insurance policies, it's not something that they can work with easily. So some of the records necessary: you have to have your farm serial number, which is done by FSA. You have to have the name of your crop and the variety. You need to know whether you're selling it as fresh or processed, if it's irrigated or non-irrigated, organic, conventional, and you have to have a production history, including planting dates and field location, and all total for all your crops harvested in the previous 5 years. So it's really, they want a history of what you've been producing for the last 5 years and how much of it. So your average yield per acre, how many, you know, if you have tomatoes, your average acres of tomatoes, your average yield per acre, and then the type of tomato and the price you got for it. There are additional requirements for fruit trees, like spacing and age of trees, that they need to know, because that affects how they're going to perform in the future. So you can go to, I'm not going to go, but you can actually go to see if you wanted to see, actually I am going to go. So give me just a second. I'm going to show you just real quick. You can actually, the link that was just up, which is FSA's like insurance locator. And the reason that Whole Farm Revenue works well for so many of our small and diversified farmers, especially in Appalachia, is, see, I've selected my location, Kentucky, in Whitley County. Let's see what crops we can insure in Kentucky. You can either do corn or you can insure your whole farm. Those are the options right there, corn and whole farm. You can't insure soybeans, you can't insure tomatoes, but under Whole Farm Revenue Protection, you could insure those crops based on your production history and sales history. You know, they really like to see 3 crops on this, but I thought that that would be a good way to go. So to kind of show you, like, this is the reason we're promoting this in Appalachians, because a lot of times there's not other options. So let me get back to the webinar. If you choose a plan, it'll tell you the important dates, like when you need to purchase insurance by, when you need to submit your farm plan, all of those things. Okay, so possible reasons for a claim. So if you have adverse weather, if it's unusually hot, cold, wet, dry, wind, hail, if you have an earthquake or a volcano or an insect infestation due to unusual weather, or, and this is kind of unique in, you know, past, and it's kind of new in the last few years with Whole Farm Revenue Protection, is lower than expected market prices or unexpected loss of a market. So if you have a market for your pumpkins fall through, or suddenly you can only sell them for half of what you expected to, that's an acceptable loss, because that impacts your revenue. That's what Whole Farm Revenue Protection is about. Things that impact your revenue. Things that are not covered. If you just don't follow good farming practices, they're able to come out and say, it looks like you decided to plant your tomatoes and then never touch them again, and that's why you had lower yields, or your market wouldn't accept them. If you just have basic neglect or mismanagement, if weeds are the issue, if you have chemical drift, or if you have animal damage. One of the things that, I've talked with a few insurance agents, and they said, they did have somebody try to make a claim for their neighbor going four-wheeling in I think it was a field of lettuce, and that is not an eligible claim. So those sorts of things are not going to work. So as I've said, with whole farm revenue protection, everything in your farm is under one policy. It is available everywhere in the country. It doesn't matter if nothing else is covered under farm insurance in your county. It is available everywhere. It provides a protection against a loss in revenue, not yield. And that's the big distinction between what some of my vegetable farmers that I've worked with, they're used to having insurance that does a lower payout based on yield because they have special markets where they're able to sell peppers, or they go to the farmer's market. And so what they're getting is more than a larger scale vegetable producer that sells into, wholesale markets, or is not organic. They're not getting as much money if they have a claim when they use policies that are based on yield versus revenue. If you suspect a revenue loss, you do need to report that to your insurance agent. And since whole farm revenue protection takes into account your whole farm, you actually don't file for a loss until 60 days. You have to file it within 60 days of filing your taxes, because they're actually going to use your tax documents to see what your revenue was. So your tax documents need to accurately reflect your farm revenue and your expenses. Indemnities, or the payment that you would receive for a loss, are generally paid out at the end of the calendar year. So, after you file your taxes and you have a claim within that 60 days after you file them, the indemnity for your loss is usually shortly following. One thing that we've had some farmers won't insure maple syrup or maple sap, and it will not insure animals for sport or show. So if you were breeding show goats and that was their primary purpose, and you lost several, it would not cover that. If you had cattle that you were milking versus cattle that are showed at a competition, the loss of the milk is what would be insured, not a cow that was in competition. A lot of people, I think people have, horses or dogs actually have tried to add this to these insurance policies, and it's not eligible. So with whole farm revenue, there's a few more things to that like general list. 5 consecutive years of a Schedule F. And if you are a beginning farmer rancher, you only have to have 3. And the nice thing about whole farm revenue protection is that if you have been growing your farm, so let's say you started out, at $5,000 or $10,000 in sales, and over the last 5 years you've gotten it to 50 or 60. They're going to look at that, and you can actually, people think they're just going to take the average of my last 3 to 5 years. Well, actually, they can, if history shows and you have new markets for your expansion, you can insure more than your average amount of sales over the last few years. So it can help ensure your growth and what you're planning for. There are some record keeping tools to help you with this. So if you are doing, this is what USDA called it, record keeping aid for direct marketers with price information. This is if you know that you sold $50 worth of peppers at the farmer's market. This is a good little tool. So I'm going to open this up just so you can see what it looks like. And I'll share that with you. You know, if you're going to do papered record keeping, and that's what you're used to, and it is a lot. So the word commodity, sometimes people, that's just what vegetable, or if it is beef, whatever the commodity is, here's the name of the market, your cash receipts, your name, the date. So this is a way, how much you took. Okay, I took this much peppers. I returned home this amount. I sold this amount. The price was this, and here's how much I made off of the peppers. Same thing with tomatoes. So they do try to give you some tools. It would be difficult to keep track of it this way for very long. We often find that people use, instead of doing it paper, they have provided spreadsheets for you that you could, like an Excel spreadsheet. You could probably use it in Google Sheets as well. So the other paper, and give me just a second and I will share that with you. Maybe a little easier for people to manage. And I'll give that. Oh, it's already up. Good. So if you're looking to keep records and you don't know exactly what to keep, here's your name, the date, the market you went to, how much cash, and then which crop it was, what percentage. So if you say, I made $1,000, 50% of it was tomatoes, so that's $500 of tomatoes, and 20% of it was peppers, and so that's $200 in peppers, and an additional, let's say $1,000. So an additional $300 of it was lettuce, or about 30% was lettuce, so that's $300. So this might be a little more manageable for where since you're not tracking it individually by each crop, you're estimating percentages and how much you sold. This is what the tool that I would use if I were using one of these tools. The big thing is just to track, your sales, which hopefully you're doing anyway. And if not, we will have a record keeping webinar later in about, I think 2 months from now. You can find more information on that at Appalachian Sustainable Development's website. So let me get back to the presentation. Okay. So important dates for whole farm revenue or sales closing. So you need to have determined what you're going to do by the sales closing date. The cancellation date is when you have to decide you're not going to do this, and your termination date. So this for whole farm revenue is March 15th. You do have to provide a farm operation report or a farm plan, which is just what you intend to grow this year. And if you need to revise that, you can do a revised farm operation report by July 15th. So you've told them on March 15th you're going to purchase insurance. On July 15th, you revise your farm operation report. You get a bill for your premium on August 15th. So you get the bill after you have told them you get insurance, which I think is interesting. Due to the high number of farm losses, the premium billing date was extended this year. So there's always, if there's special circumstances, they will take that into account. If you need to change your contract, the last day for that is August the 31st. And I haven't had anyone need to use that. So approved revenue. This is how they figure out, if the number that they expect you to have this year. Like if I'm going, here's how much we expect your farm to make this year. Here's how they figure that out. They look at your whole farm history report. That's that 5 years of history we're just talking about. How much you pledged to this, the spacing, how the yield, the price. They're going to look at that. You can do 3 years if you're a beginning farmer. A farm operation report. So that's your plan for this year. Looking at the strength of past growth and markets for new growth, so you can actually do expansion, and your coverage, and your coverage level. So revenue, if you have unsold inventory, let's say that you have unsold cattle, or if you had unsold sweet potatoes at the end of year, those will be adjusted from your revenue And actually that is also recorded on your tax documents that you give them. So that should be there as well. What scares most people off about this once they think that they would like to purchase it is the record keeping. But if not having the farm revenue is going to make it so that it's a hardship for your farm business, your family, or to be able to farm next year, a few hours of record keeping is not the end of the world. And it sounds much worse than it actually is. The biggest thing is, if you know that you want to have insurance in the next 5 years, start keeping some records now. It doesn't have to be daily records or weekly records, but it needs to be like, here's how much I grew, here's how much I sold, those basic records. Here's what the yield per acre was. Those records will help you be able to purchase farm insurance in the future. So I talked about premium subsidies. You have if you only have one commodity or one thing that you're selling, they're not going to subsidize much as if you have 2 or 3. And you can see there, if you have 3 or more things that you're selling, if it's peppers, pumpkins, and cattle, you are eligible to get 80% of your premium covered. And you can actually insure 85% of your that revenue number they come up with. So if you remember on the last one, the revenue number that they did, you can actually insure up to 85%. For most policies, though, people don't usually go above 75% because there's that nice thing that they're paying for 80% of your premium. That does make it more lucrative. It's kind of a trade-off. You get a few more hours paperwork, the federal government subsidizes your insurance. Not a bad trade-off. Now, if you want to get an estimate of how much it's going to cost, this website will actually help you with that. And I'm going to switch windows again and show you and take you there, because it is, I found it. I was just so excited that we could do this. And you're going to see this for just a moment. So you can get what's called a quick estimate, and it's ewebapp.rma.usda.gov/apps cost estimator /estimates/quick estimate. Or you could probably Google it or get some of the follow-up information that we'll be putting out from this webinar that has this link on there. And you'll see it just goes, with the commodity, whole farm revenue protection, because it was either that or corn in Whitley County, Kentucky that I can be insured with. The commodity year 2020, that's when I will be growing, or the hypothetical person who's actually not me. We're in Kentucky, Whitley County. We file our taxes in the calendar year. No practice specified, so not going to worry about that. I'm not going to go. I haven't had a lot of interaction with other MPCI, multi-peril crop insurance liabilities. And it's not something that generally the first-time purchaser is going to have. So if you look at what you're going to do is you're going to estimate how much revenue. You can go back and look at your taxes, because that's what they're going to look at when they estimate how much you are approved for. And say, here's the farm income over the last 5 years from 2014 to 2018. And then you go down here to the select a commodity thing, and you can go anything from broilers, which are, chickens, to cattle, clover, you're producing clover for forage. Game birds are eligible. Furs are eligible if you're raising animals for fur. Hogs, you're raising hybrid corn seed. Mustard, nectarines, probably not in Kentucky. Winter squash, sweet cherries, sweet corn for fresh market, or if you're doing it to have it processed into some corn and bean salsa. So I chose simple things. I chose peppers, pumpkins, and tomatoes. So I put in there how much of my sales I expected that to be this year. And it's going to take just a moment. We're going to click Get Estimates. We're going to pretend that if you're watching this webinar, this was probably your first year of crop insurance. Is there any known damage? So if you had apple trees or blueberry bushes, is there any known damage? No, none that I know of. We're going with a best case scenario. The bears have not been into your apples and destroyed your trees, hopefully. So we have to wait. But I do like to show this because the fact that you can get on there and estimate what your coverage level will be, how much it will cost you to get the coverage, you know, so what your approved revenue would be, but you can look at how much it will cost you for different coverage levels. And that's really nice. It's very, very nice. So, and it blocked a pop-up. But I know the answer to this, so I'm going to show you. It gives you a big table. And thank you, Microsoft, for doing that for me. I actually, because it doesn't like that website sometimes, you have to enable your thing. So there's the same numbers that I just put in. So here's the premium example. So let's see. If you were insuring, I think the average ended up being right around 100 grand, about $98,000 of sales, so, or revenue. So if you were insuring, the numbers on the left are your higher coverage levels. So as you go down here, if you wanted to insure your crops or your farm revenue at 70% for around and you had about approved $100,000 in annual revenue, that would cost you around $1,000. Based on that, this is based on the scenario I just input. So if you're looking at growing 3 crops, you know, peppers, tomatoes, and pumpkins, you think you're gonna have about $1,000 in sales. Your total premium is $5,400 some dollars. The federal government's gonna pay $4,300 some dollars of that, and you would have to pay $1,000. And what that means in the real world. So there's your premium example. Let's do an actual example. Kelly got 75% coverage. You'll see this is directly related. With an approved revenue of $97,600. So her premium after the subsidy was $1,093. She loses 25 grand because of pumpkin field floods, which happens far too often, unfortunately, in our hilly areas. Things flood. And then she loses another $15,000 because of all the hail damage she gets in peppers and tomatoes. So she thought she was hoping to make $97,600 this year. That was her approved revenue and what she had hoped for. And her actual, you know, what she actually made was $60,000. So since she was insured at 70%, she's gonna get $8,000 indemnity or payout. So what she does after she submits her taxes, she submits her claim, and once her claim is accepted and approved, she would get $8,000. It did cost her $1,000 up front to insure it. Now, what I would recommend you do is to go back to that quick estimator and put in, you know, here's what I think my averages are. Here's the crops I intend to do. You know, don't have to be horribly, horribly detailed. They can be round estimates and see, because, you know, insuring $68,000 of revenue for $1,000 is not a bad deal if it's going to be, because that $8,000 could be the make or break between being able to farm next year, being able to afford the farm. You know, that's what you want to look at. You know, how much coverage do I need? How much do I need to make? What is the minimum? And that's what, you know, that could be the mortgage payment on the farm. That could keep her from taking out an emergency loan at a high interest rate to do it again next year. So, or in farming at all. So if you're familiar with NAP, you know, NAP covers one crop with each premium, whereas whole farm revenue protection is a single premium that covers everything all together. So Kelly had some small losses in different areas that contributed to a larger overall loss. Like each one individually, if she had had NAP, probably wouldn't have been enough depending on her coverage level. And since it wasn't based on sales, just yield, then it may not have been enough to trigger having an indemnity or an insurance payment. You know, If you're looking for catastrophic coverage for a few important crops and that's all you want, like if worst case scenario, we have almost no yield, I'm not worried about a price premium, NAP may work for you. But for many of the farmers that in Appalachia, in Eastern Kentucky, West Virginia, Eastern Tennessee, Western North Carolina, this makes more sense because they're doing a specialty crop, they're doing it on a smaller scale, and they're really dependent on a higher price point than what NAP would take into account. And that's the reason we really chose to highlight this. So why would you buy it? Like I said, cost of inputs for next year. It can assist sometimes, and this is sometimes if you're taking out a loan, your lender may want you to get crop insurance because it takes away some of the risk for them. It can be an asset for them, for you to have insurance, because it might allow you to make the mortgage. It might allow you to make the payment on a tractor. It can help provide, it doesn't do everything in every scenario, but for what happens, I mean, if you think about it, whole farm revenue protection covers if you have a substantial loss in pricing. It's about your revenue. So it can help provide some peace of mind, and it does mitigate what you cannot control. The weather, external markets, you can't control those. This is a way to help mitigate your farm risk, help stabilize it a little. It won't help every scenario, but many of the scenarios. Here are some resources. This is the Whole Farm Revenue Protection Frequently Asked Question sheet for this year. There are a couple of things that have changed between this year and last year. One of the things is that previously, if you purchased NAP with Whole Farm Revenue Protection, it would reduce your Whole Farm Revenue Protection premium further. That no longer works. So that Whole Farm Revenue Premium Estimator, which is the second link, and it's the one that we went online with, that one is much better. It's a pretty good estimate. It's been within, like, I don't think it's been off by more than $100 for some of the farmers that we've worked with it, and then got actual insurance agent estimates. And the NAP, if you're still interested in NAP, you just kind of want some catastrophic coverage for some very baseline things, it can work for you. That's still there, and remember, that's not through an individual insurance agent. So that is it for Whole Farm Revenue Protection. Feel free to contact me with questions. I've had a few farmers, ask how they approach insurance agents. Sometimes if you call your insurance agent and say, I want to insure apples, and they're like, well, can't do that in your area. If you say, I want to purchase Whole Farm Revenue Protection, just how to have that conversation. If you have any question about that, if you want to look at your financials and business and kind of go over, is this time for you? How much risk, plan for the future, be more than happy to help with that. And then, of course, the Kentucky Center for Agriculture and Rural Development, that's our general contact information. And I hope that we've covered and answered some questions and made the concept of farm insurance a little bit less daunting. It's not a subject that people bring up to me. I usually bring it up to them and say, hey, you've hit this level of sales and you've quit your full-time job and you're farming full-time now, and this is how you're supporting 50% or more of your family. So let's consider helping mitigate that risk. Let's consider what happens if. And it's something that I think can work with a lot of our Appalachian farmers. Actually, I know it can. I've seen them use it. So one farmer I've spoken with, had a loss his first year, and he hasn't had a loss since, but that first year, it made a huge difference. So, and it allowed him to keep farming and support his family. So I think, it's a good tool to keep in mind, especially as you become more dependent on your farm income and it becomes more important to you. Thank you. I hope you've enjoyed. Feel free to contact me. There will be some additional information available on Appalachian Sustainable Development's website shortly, and I hope you have a good day.